Hello, hello. What is up? What's up, everybody? Thanks for hanging out here. Thanks for being here with me today. This is going to be another selection, another edition of the Trading Quotes playlist here on my YouTube at Sheds Trading. I have published 4 books. You can see them here. And the Trading Journal has recently, within a few months, been published. And what I'd like to do when I have a new book is make my book before it free, and that's what this is. So I've been going through and recording one chapter at a time, and the idea is that I want to create some value and create the ability to discuss these topics. And trading quotes are fun, and so Trading Quotes playlist. While you're here, folks, check out the Trading Encyclopedia. It's a new playlist I have, 3-minute videos teaching you professional TA, classical charting, Japanese candlestick theory. So make sure you check that out. As you know, of course, I'm on Bitcoin Live as well, a founding analyst there, and on Twitter at Big Cheds. So let's go right into it. This is for the playlist Trading Quotes, and let's get started. And we left off last time we did weeks 20 and 21, and we're going to do weeks 22 and 23 today. So, folks, thanks so much for being here. Monday. Step number 1 in trading is to survive your mistakes. So we know you cannot become a successful trader. You cannot go from a novice to a professional, or even a novice to an intermediate, without surviving a series of mistakes. Because in theory, just one really bad mistake can be the end of your bankroll. You can get liquidated. You can go all in. You can make all sorts of mistakes. You can make all sorts of take all sorts of risks that there's no reason to take. And so understanding that learning how to do anything, especially learning how to trade, is a long journey. You're going to have to make mistakes. You're going to have to learn from them. Keep that in mind. Understand you need to survive your mistakes to gain that experience and then to thrive in the future. So step number 1 is to survive your mistakes. Tuesday, always have funds available for the next candle. Never go all in. And this ties in with the first quote here where I said you can make a big mistake. If you go all in, you can get yourself in a lot of trouble. You want to leave yourself some flexibility with your bankroll, understanding that the markets are tricky, and even trading levels, price levels that you're using to manage your risk, the price can chop around there. You always want to have the ability to add to a position, to scale in, to reduce your position size, to scale out. And if there's a new opportunity that comes around, like a really good opportunity, there's been some volatility that shook the market, and you have, like a price drop back to a well-defined support level in an uptrend in a chart you're familiar with, you want to have funds for that. So you don't want to put all your chips into play at any time. You always want to leave a certain amount, of funds available for the next play. So always have funds available for the next candle, and do not go all in. Wednesday. I love buying something when other people are uncomfortable with the idea of buying that thing. And so it's a thing. This quote speaks to sentiment. And we know sentiment at the top is frothy. Sentiment at the top is just unbelievable. And you feel like you're going to miss it. You don't want to miss it. It's going up, whatever it is. You're afraid that you're going to miss it, right? And there's the opposite of that is when nobody wants to touch something, or people are really complaining, oh, Ethereum looks bad, it's really beat up. Well, there might be some opportunity there. And of course, you want to look for a dip in an uptrend, in high time frame at least. But the idea that I like to buy something when other people are uncomfortable buying, there's been a shock dip, but the price is at support. And I know it's a good entry, but other people are freaking out. And they're worried about potentially more downside. But I don't mind. I can play that level, and I can manage my risk. Thursday, the more times resistance or support is tested, the more important it will be in the future. If that level is eventually broken, that break carries more significance given that price interaction. So this is a classical charting principle that has to do with a level. And the more times a level is tested, the more important it is, right? It's also true that the more times it's tested, the more likely it is to break. And also, if it's an important level, you want to pay attention to it. If it keeps getting tested and then it eventually breaks, that's a big momentum clue. It shows that, for example, with an uptrend, it set a resistance. It tried to knock through it several times, and then it eventually did. That tells you you had a good rebalancing of short-term supply and demand, profit taking, and now you have a good chance to continue higher because there's a big momentum clue from recapturing that level. So pay attention to the price if it really starts to interact with the level, and then if it breaks, you really want to pay attention. Friday, every market reaction to news is an overreaction. Wait for things to settle down before drawing a conclusion. This, of course, is an oversimplification. Not every market reaction is an overreaction, but very often it is. And if you just kind of relax a little bit and you let things settle down, those short-term speculators will rotate out and you kind of see what's left over. You want to let things settle down rather than you jumping to a conclusion right away. There's a complex process where there's been buying in anticipation of the news. Maybe the news delivers, maybe the news doesn't deliver, but you want to give yourself a little bit of time and not get faked out, shaked out, chopped around. So just wait for things to settle down before drawing any kind of a conclusion based on, some type of big news event. You see it all the time, like in the New York Open, or even when some of the economic data comes out. I mean, if you drop to like a 5-minute chart, you get these big zigzag moves. So you just got to let those things play out and settle down before you jump to a conclusion. Saturday, buying too early often leads to selling too late. It's really interesting. So you say it's like a downtrend, and you bought before any kind of a bottoming process has started to form. You just bought in because you thought it's oversold and it's beat up, and I'll just scale and I'll just dip my toes. You keep buying in. Now, what happens is at some point maybe it starts to bounce, and it might even bounce enough to get close to or back, near your entry. And now other people who bought the actual bottom, who waited for some type of a structure, now they're taking profit because their trade idea has played out. Whereas you got in too early and now you can't sell, you're selling too late. And then the price bounce fades and heads back down, and now you're panicking. And so you not only bought too early, and now you're selling too late. So just don't buy too early. Let things again settle down. Give yourself something to work with. Use like a 2-level filter. Look for, some type of a key level to get recaptured before you jump back in. Sunday, if you feel the need to defend every negative comment you see about a play you are holding, that is due to an unhealthy level of emotional connection. Be dispassionate with your plays instead of falling in love with them. You can get into, I've done this, of course. I've done all these things that I talk about, right? I'm not sitting in, in a white castle here on top of the hill and judging everyone, but you get to a situation where you're stuck. You feel like you're stuck, and when news comes out or when people talk about that play, it's just you don't want to hear anything bad. I don't want to hear it. I don't want to hear it. Don't tell me it's gonna be bad. And get into a situation where you're defending it. Oh no, you're wrong. And it's like all of a sudden now you're married to this play. You're married to this bag. When you should just say, this is a play, I'm trading it. It's just letters on the screen. It's not a company. It's not a project. It's just an opportunity, a trading opportunity. And I have a trading idea. And my trading idea is either still valid or it's failed. And if it's failed, move on. Be dispassionate, right? Just don't care what you play. I don't care about what I play. Like if the market likes it, I like it. If the market hates it, I hate it. And I don't spend time arguing. And if I know if I'm in a position where I see someone talking about a play that I'm holding and I get like a negative reaction, I know I've messed up already. I have too much money in it. I've become too emotionally connected. So you want to try to avoid that at all costs. Week 23, Monday. Deploy your funds in the direction of relative strength. This is true because, sure, the whole market often will generally move in the same way, but the relative strength players will have higher bounces. They'll put in higher lows. I always talk about having in mind, 3 or 4 plays, the strongest plays in the market, the strongest charts in the market. And when you get a lot of volatility that will reset things, you want to target those relative strength plays. They're more likely to recapture lost support. They're more likely to rejoin those larger bullish trends. So just as a general principle, just play strength. Trends tend to continue. Make it easy on yourself. Don't target downtrends or reversal. Don't target weak plays thinking, oh, if I just get in here and it's the bottom, I can ride it. It's probably going to go against you. So don't fight the trend and make sure to deploy your funds in the direction of relative strength. Week 23, Tuesday. If you do not see a clear signal, wait for one. New and better opportunities are around the corner. Do not let boredom or greed force you into a bad trade, right? When you look at a chart, and this has to do with muscle memory, this has to do with you preparing and studying and knowing, what you're playing. And so when you look at a chart, you should have a really good idea right away. Is this an uptrend? Is it a downtrend? Is there an opportunity? You should know. And if you don't have a good feel, just don't play it, right? There are mixed signals. You want to play something that's clear. You want to play something that's going to make it easier for you to succeed. There's always other opportunities, especially in 24/7 markets, which crypto is, but even equities is moving towards. So just understand there's going to be other opportunities. If you're bored, go play chess. Go build a fort with your kid outside. Like, go do something, but don't let that be the reason you're entering a trade, all right? Or greed. Just focus on waiting for opportunity and understand if you don't see a clear signal, there's nothing there. All right. Wednesday, define your risk before it defines you. What does it mean for the risk to define you? Well, the risk can define you when you get stopped out, when you get liquidated, when you have to panic sell down 90%. And so what does it mean to define your risk? Well, part of defining your risk is defining your trading idea. Like, what is the idea you have to begin with? Why are you even in the trade? I mean, we're talking about your hard-earned money. You're putting at risk here. So you have to have a thesis. The thesis is, okay, it's, inverted head and shoulders that just broke the neck baseline. Okay, so you're clearly long because you just broke the neck base. But if it comes back below and it fails to hold the neck baseline, you don't hold the trade because your idea has failed, your thesis has failed. So you define your risk by defining your thesis and then knowing where the thesis will fail. Then you can take a small loss before it turns into a big loss and before the market defines the risk for you. All right. Thursday. Sometimes you roll the dice and sometimes the dice rolls you. This one's fun. Of course, it's a play on words, as many of my quotes are. But it's, sometimes you just take a shot. Let's see, this looks like a good opportunity. Let me try and let me see what happens. And sometimes it works out great. Other times it just seems like nothing you do works. It just seems like you're getting in trouble, you're failing, you're losing your trades, and the dice is rolling you. And it is what it is. And this basically says, there's good days and there's bad days. It happens to all of us. You just give it your best shot and move on. And all you can really do is try to learn from the mistakes, learn from the lost trades, see what value is left over, and just know that sometimes the dice will roll you. Sometimes you get unlucky. However that manifests, however you define you getting unlucky, it will happen. So you just have to accept that and move on and live to fight another day by defining your risk, of course. Friday. If you have to keep switching between log and linear mode to find a trend line that suits your bias, the line is not the problem, then your bias is. This is a very kind of an inside thing. I mean, you have to really even know, like, what does that mean, log and linear? This has to do with technical analysis trading. Of course, logarithmic and linear mode, and essentially the difference between the two when you're looking at higher time frames and higher volatility moves. You generally using logarithmic. You can use linear in other situations, but it's a situation where when you switch between log and linear, the price will expand and contract a little bit in the way that the candles are displayed. And so you can draw a trend line a lot of different ways. And if you find that this trend line is not lining up, let me just switch time frames a little bit, or let me just switch log to linear and see if my time frame works, if my trend line works here. I mean, you're like trying to make it work too hard. It's not there. That's like a huge red flag, right? Like if you're like, oh, I need to keep switching between log and linear until my bias, the price will match my bias. That's not good. You should just use one, stick with it, don't switch, and then let your trade idea come from the price and the truth of the price and whatever the price is doing. Is it holding support? Is it breaking resistance? If you find yourself doing this, it's just a major red flag. You've gone way far afield. Okay. Saturday. The interaction of supply and demand is what determines the price. It does not matter if you think something is too cheap or too expensive. The market will make the ultimate decision. Rather than arguing, pay attention and trade accordingly. You hear this all the time. This is so undervalued. Oh, this is overvalued. I actually don't even believe in those concepts of undervalued and overvalued. For you to say that is to believe that the market is wrong. And I don't like operate that way. I don't understand how you can think the market is wrong, because the market is a summation of all participants, all buyers and sellers, all their ideas, all the bulls, all the bears, all the greed, all the fear, everything rolled into one. And so you have the price. And if I want to go buy it right now, that's the price and that's what it's worth. So the idea of it being overbought and overvalued or undervalued are myths. These are you think the market's wrong. And that's how I see that. So it doesn't matter if you think it's too cheap or too expensive. It's not up to you. Just stop arguing. Just don't argue with the market. Just take whatever's there. The market's going to make the decision. Just pay attention and then trade accordingly. Stop getting stuck in this idea of it should be more, it's worth more, it's worth less. No. It's worth what it's supposed to be at any given time. It's worth what it's supposed to be. Okay? Sunday, your primary mission as a trader is to buy dips in uptrends. If you do nothing else, you will succeed. And this is the thing I talk about a lot with newer traders and just older traders too, but understanding that you should orient yourself, number one, to trade with the trend. Price above a rising MA200, it's an uptrend. If you wait for a dip, you can buy a smaller move against the broader trend. And most of the time, trends will continue. Trends tend to continue. So something like a bullish throwback, which is a retest of broken resistance in an uptrend, play that. If you just simply decide to be the type of trader who's going to only play uptrends and it's only going to buy dips and uptrends, you're probably going to do pretty well. One of the easiest ways for newer traders to get into trouble is to guess when a downtrend's going to reverse. Oh, it's going to reverse. Oh, no, this is the bottom, and trying to figure it out ahead of time. That's how you're going to get yourself into a lot of trouble. So your primary mission as a trader, just buy dips and uptrends. If you do nothing else, you will succeed. Weeks 22 and 23, we'll do 24, 25 next time in the next video. This is, of course, my third book, Trading Quotes, A Daily Dose of Trading Wisdom. I published this in 2022. I have a new book out, The Trading Journal. It teaches you why to use a trading journal, how to use it, good trader habits, emotional management, trading setups, all that good stuff. I'm trying to put it all on my YouTube channel at Ched's Trading. I'm trying to pretty much make all my books free. You can get them on Amazon. You can buy them there and or get them for free on my YouTube. This is going into the Trading Quotes playlist. Check me out on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. While you're here, go binge watch the Trading Encyclopedia playlist. I think you'll love it. So, folks, thank you so much. Let's finish up, of course, with a little bit of dancing and the Church of Eight Wheels, and we'll go from there. But, folks, thank you so much for being here for this this last video. Thank you. Big Chaz out.